Hi, I'm Certified Personal Property Appraiser Dave Maloney, author of Appraising Personal Property Principles and Methodology. This video is another in a series of hot topic discussions for the personal property appraiser. To see all my videos, visit my YouTube channel at youtube.com/asktheappraiser. Note that throughout these hot topic discussions, I make reference to USPAP. USPAP is an acronym for the Uniform Standards of Professional Appraisal Practice, which are promulgated by the Appraisal Foundation of Washington, D.C. The goal of USPAP, which is updated biannually, is to maintain public trust in the appraisal profession. For more information about USPAP, visit appraisalfoundation.org. This hot topic discussion addresses the methodology underlying the development of an opinion of replacement value comparable for an appraisal assignment for which the intended use is for the client to acquire insurance coverage under an agreed value policy, such as a homeowner's insurance policy floater for scheduled high-value items. I will also discuss the markets from which data is typically obtained, data on which the appraiser bases his or her opinion of value. Such markets would certainly include retail sources, such as dealers and galleries, but auction markets might be used as well if need be. Let's set the stage for this discussion. My book, as well as my online appraisal course, emphasizes USPAP and USPAP's appraisal process. The very first step of the appraisal process, which is problem identification, requires the appraiser to identify several elements of information before proceeding. One of those several elements of information that must be identified at the very beginning of the appraisal process is the intended use of the report. Another is the type and definition of value to be developed, along with a citation as to the source for that definition. There are other elements of information that must be identified during the problem identification phase of the appraisal process. For a detailed discussion of the appraisal process and of problem identification, watch my YouTube Hot Topic videos number 1 and number 2. But intended use and value type being employed and its definition are of special significance because identifying intended use and value type and its definition enables the appraiser to then, in turn, identify the appropriate market in which to conduct research in order to locate market data on which to base an opinion of value. Without having first identified intended use and value type and definition, the appraiser is unable to identify the most appropriate market and, as a result, would be unable to continue with the assignment. Here are a couple examples. If the intended use is for federal tax purposes, such as for donation or federal estate tax, the IRS tax code and Treasury regulations defines and requires the use of fair market value. Consequently, the appraiser identifies fair market value as the type of value to be developed and makes use of the government's definition of fair market value. And the government's definition of fair market value addresses the market to be researched. It requires the appraiser to seek market data from within the most common market in which comparable properties have sold in the past to the retail buyer, that is, to the end consumer. The appraiser uses his or her experience and judgment to identify which market is the most common market. A second example would be an appraisal assignment for which the intended use is to enable the client to acquire insurance coverage. This second scenario will be the focus of the balance of this discussion. For agreed value insurance appraisals, the appraiser identifies and defines replacement value comparable as the type of value to be developed. Note that in this second example, I am focusing on replacement value comparable and not on fair market value. The reason being that for the intended use of acquiring insurance coverage, the type of value being developed must, in the case of a total loss, reflect the amount of indemnification the client should receive so that he or she would be able to purchase a comparable replacement property within a reasonable time from within the market in which the insured customarily shops. Why am I focusing on replacement value comparable as opposed to replacement value new? The answer is simple. Nearly all appraisals done for the intended use of acquiring agreed value insurance coverage have as their focus personal property which is appreciating in nature, that is, that goes up in value over time. Such items can be replaced only with a comparable item and never with a brand new item. Examples of such appreciable property include vintage clocks, 19th century furniture, sterling silver, jewelry, fine art, historical Americana, Tiffany lamps, etc. Because of their value-relevant characteristics such as age, authorship, provenance, rarity, etc., such appreciable property cannot be suitably replaced with a brand new item. They can only be replaced with a comparable property, that is, a property having similar value-relevant characteristics such as age, condition, provenance, aesthetic appeal, authenticity, originality, authorship, etc. Having said that, for some assignments the appraiser might be required to develop an opinion of replacement value new, but for depreciable types of property such as a modern sofa, lamp, refrigerator, or flat-screen TV. Such items are capable of being suitably replaced with a brand new item. An example of such an assignment in which the appraiser develops an opinion of replacement value new would be one having as its intended use the settlement of a casualty loss insurance claim or a transit-related damage claim. But for assignments for which the intended use is so that the client can obtain agreed value insurance coverage, the types of property involved will typically be appreciating and not depreciating in nature. Therefore, replacement value new is irrelevant. Instead, we must focus on developing an opinion of replacement value comparable when appraising appreciating personal property for insurance purposes. At this point in the appraisal assignment, the appraiser has identified the intended use for obtaining insurance coverage. The appraiser has also identified the type of value to be determined, replacement value comparable. Now the appraiser must identify the definition of replacement value comparable and must cite the source of that definition. If you have a favorite definition, go ahead and use it and cite its source. I cite and make use of the definition of replacement value comparable that is in the 5th edition of my book, Appraising Personal Property, Principles and Methodology. This definition is the most comprehensive, accurate, and understandable definition of replacement value comparable that I know of. It states, replacement value comparable is the worth of an item based on the amount necessary to obtain a comparable substitute property that would provide the same enjoyment, usefulness, and other rights of ownership as did the subject property. Replacement value comparable is based on the substitute property's replacement cost comparable. For items not capable of being replaced with a new property, replacement cost comparable is a total buyer's cost necessary to replace through purchase the item being appraised with a comparable item of property of like kind, age, quality, and utility having similar wear and tear, obsolescence, and value-relevant characteristics as the item being appraised. Replacement cost comparable is useful when estimating the replacement value comparable of items not capable of being replaced with a new property, such as antiques, collectibles, or works of art by a deceased artist. Having identified the intended use and the value type and definition, as well as the other elements of Step 1 of the appraisal process, problem identification, the appraiser proceeds with the next steps of the appraisal process by identifying and performing the scope of work necessary to achieve credible assignment results. As with all assignments, for our insurance appraisal, an important scope of work step is to identify the appropriate market to research. For an insurance appraisal, research in the appropriate market must yield data on which to base an opinion of replacement value comparable. By the way, The market we research when developing an opinion of replacement value must be client-centric. That is, the market chosen must be selected based on the needs of the client. This, by the way, is as opposed to markets chosen when developing an opinion of a type of market value, such as fair market value, marketable cash value, or early liquidation value, in which case market selection is governed by the expectations of market participants and not from the perspective of the client. But this is a topic for another day. Basic appraisal theory teaches us that replacement value, either comparable or new, always assumes that the replacement will occur within a reasonable amount of time from the market in which the insured customarily shops. Insurance companies recognize the need for the insured to obtain a replacement property within a reasonable time from the marketplace in which the insured normally makes purchases, such as a local antique shop, via an interior decorator if one is normally used, or from the internet. The insured should not be made to wait an excessively long time in hopes of obtaining a replacement property at a lower price, say from a discount source, that may or may not have the item on sale at any particular time. Nor should the insured be required to undertake an extensive shopping expedition or to purchase a replacement property from a market in which he or she does not normally shop. So, when preparing replacement value appraisals based on replacement cost, the appraiser should make use of retail markets in which the insured customarily shops, and in which the insured could make replacement purchases within a reasonable amount of time. Examples of such markets for appreciable property would typically include retail antique stores, art galleries, or internet sites carrying properties comparable to the subject property. These are all examples of appropriate markets in which the appraiser would normally conduct research. But when dealing with rare and sometimes unique items of appreciable property, comparable properties are often unavailable within the typical appropriate markets. A Tiffany lamp having the same pattern and base as the subject property cannot be located currently for sale, or a painting by a listed artist is not currently for sale either. What does the appraiser do when the most appropriate markets such as retail stores or the internet in which the insured most customarily shops fail to produce comparable market data on which to base an opinion of replacement value comparable? The appraiser will often face this dilemma. We'll come back to this point in a moment, but before we do, let's review the approach to value which we will be using in this assignment, that approach being the sales comparison approach. For a USPAP summary report, which is a report option typically used for insurance appraisals, USPAP requires that we summarize the appraisal methodology used, including the approach to value we employed. By the way, USPAP also requires that we summarize the reasons for excluding the use of any of the three approaches to value as well. And for the intended use of obtaining insurance, we normally exclude both the cost as well as the income approaches, using only the sales comparison approach. By definition, the sales comparison approach makes use of either current asking prices or past consummated sales as a basis for an opinion of value. Here is the description of the sales comparison approach that I use in my reports. In the sales comparison approach, the most appropriate market is researched to locate comparable items which have sold in the past or which are currently being offered for sale. Should a comparable suitable replacement not be readily located and available for purchase at retail, local and national auction sales are researched to locate comparable items which have sold in the recent past in order to establish replacement value comparable. Adjustments in value are made to reflect differences, if any, in value-relevant characteristics between the comparable properties and the subject properties. I also note in my report that the type of value I am developing requires that I choose an appropriate market from my client's perspective, that is, the market in which the insured customarily shops. So I state in my report, The type of value being used in this assignment, replacement value comparable, requires that I consider a market in which you customarily and conveniently shop, and in which you should be able to purchase a replacement property within a reasonable amount of time. Accordingly, I considered local retail antique stores and internet retail websites specializing in the sale of high-value properties comparable to yours as the most appropriate markets. Now, back to the dilemma. What to do if you are unable to locate comparable properties currently being offered for sale at retail sources such as galleries or dealer shops on which to base an opinion of value? The answer is to use past consummated sales. Life is not perfect. Finding dozens of comparable properties to use as a basis for our opinion of replacement value comparable lining the shelves in dealers' shops is often a pipe dream. So, we must use the only option left, making use of past sales, which, in scenarios such as this, would then be the best and only remaining indicator available of replacement value comparable. The best documented, most readily available, and most frequently used source of past sale prices, by the way, is the auction market. This does not prevent the use of past sales by dealers, including yourself if you are a dealer, but frankly, obtaining such information from dealers is extremely challenging. As a result, when necessary to rely on past consummated sales, most appraisers head straight for the auction market. In using auction results, I would amend the previously mentioned statement by adding the following. For items that are not currently being offered for sale within your customary market, I used past sales of comparable items at local and national auction galleries in order to develop an opinion of replacement value comparable. Now for the big question. Should you make any adjustments to these auction sales results? Of course, you'd make adjustments for differences in value-relevant characteristics, if any, between the comparable and the subject properties. And you would also make adjustments for changes, if any, in the market between the date the comparable sale occurred and the effective date of the appraisal. Have prices gone up since the sale of the comparable property? Gone down? But you might also feel compelled to attach, say, a 20% or 50% premium to the auction prices, simply on the assumption that all auction sales are consummated at the wholesale level. You might feel that by adding the premium, you compensate for the wholesale nature of auction sales, and by doing so, you more accurately reflect the cost that your client would actually have to pay if replacement became necessary. Should you do this? There really is no clear answer. This is one of those gray areas for which, when encountered, I turn to USPAP for guidance. USPAP's Standard 8 states that the appraiser's conclusions must be communicated in a manner that is not misleading, and that the report contain sufficient information to enable the intended users of the appraisal to understand the report properly. The blanket assumption that all auction sales occur at the wholesale level is, of course, not accurate. To assume so would be misleading. A good percentage, some say the majority, of auction sales are now to retail customers and not to dealers intent on reselling. Unless you have clearly established that the purchasers of the comparable properties which you're using were dealers intent on reselling, I would stay clear of adding a compensatory premium. On the other hand, if you can verify, and this is normally very difficult to do, that the comparable sales were indeed made at wholesale to dealers intent on reselling, you could conceivably make the argument that a premium should be added. But how much of a premium? Your knowledge of the market, your years of experience, and perhaps even consultations with dealers and colleagues should provide you with the ability to use your judgment to answer this question. In such a case, ensure that you explain your methodology sufficiently, including the assistance provided by others, so that the report can be properly understood and will not be misleading. Short of such support, I'd suggest you forego tacking on a premium and make use instead of only the hammer prices as a close enough reflection of the subject property's replacement value comparable. USPAP gives wide flexibility to the appraiser. Remember that USPAP is a minimum standard. Add as much additional information as you want in order to make the report understandable and non-misleading. This concludes this hot topic discussion. For several hundred pages crammed with how-tos for the personal property appraiser, get a copy of my book, Appraising Personal Property, Principles and Methodology, at appraisalcourseassociates.com.